Let's work through some problems on Chapter 6 related to merchandising and how to handle merchandising and inventory transactions. This is calculating shrinkage in a perpetual inventory system. We didn't really talk too much about it under a perpetual inventory system other than to say that we can for sure come up with a number because we are updating our cost of goods sold and we are updating our inventory as we go along. Therefore, we have an idea of what inventory is according to our records, which indicate the amount of merchandise coming in and the amount of merchandise going out in sales. So we can actually come up with a shrinkage number using the perpetual inventory system. We couldn't do that under periodic. So how do you calculate this shrinkage then under the perpetual? This campus store has a beginning inventory of $4,000 and then they buy $41,000. So I'd say, well, what is goods available? Goods available is always beginning plus purchases. So the 4 plus the 41 or 45,000 for a goods available number. And if you sell 30,000, then that's the cost of goods sold of 30,000. So ending inventory should be 15,000 just based on our equations. There, on the other hand, at the end of the month, they find 13,000 being there. So they are short 2,000. What would we do to correct this in terms of a journal entry? Well, you would need to reduce your inventory by 2,000 and record shrinkage as an additional cost of doing business or a cost of goods sold. The calculations again, beginning inventory plus purchases. They're not giving us a line here for goods available. Goods available with these two combined would be 45. Their actual cost of goods sold, which they have recorded according to the perpetual system, is 30,000. Ending balance then should be 15 because goods available either shows up in cost of goods sold or it shows up in ending inventory. Should be 15. It is actually 13. So 2,000 they should take out of their ending inventory number, reduce it, make it actually 13. Then after the journal entry, their actual ending inventory number will be reduced to 13,000 after this journal entry. And cost of goods sold will reflect the $2,000 loss from shrinkage. Now we have a company here, an Italian company, and I'm assuming this is lira, and 7.1 billion lira 2012, 6.2 billion lira in 2011 in sales. They have gross profit, which also changed, and they were asking us a number of questions about this, and they're saying, okay, the gross profit did change, it increased. Is it coming from sales? Did sales increase? Or was it a change in the gross profit percentage? What is really happening here? And when I do the calculations, I find that there's both an increase in sales and an increase in gross profit percentages. And I would really like to know, are they selling more merchandise in units, or is it their selling price of each unit that's changing? But here are the calculations then. To calculate gross profit percentages, we would put this number of gross profit over this number, multiply it by 100 to make this in this format. Now if you just kept it this number divided by this number, you would get, of course, 0.662, and I know most of you would see, well, that's 66.2%. I wouldn't have any problem in moving the decimals. This one again is 4.1 divided by 6.2, and that's how they get the 66.1%. So gross profit percentage, this is the first year, this is the second year, is increasing, and they also see here that sales is increasing as well from 6.2 to 7.1. Now, this one we have to go back and remember again that, oh, I said it was so important, the series of equations that have to do with merchandising. Beginning inventory plus purchases is what? Goods available. Goods available is also cost of goods sold plus ending inventory. The little thing they've added here is that there's shrinkage. Now what is shrinkage? Shrinkage is a difference between these two numbers. Here we have under ending inventory, under our perpetual system, we have 150, and ending inventory as counted is 150. No problem. However, down here we have ending inventory, which we believe before we did our count, we thought we had 210 in our inventory. After we counted, we only had 200. So what have we lost? We've lost 10 there. We don't know what happened. We don't know where it is. Our assumption is that this 10 is in theft. So let's go through and fill these in, and I'll discuss them. This one is fairly easy to get at, this 10, because we just talked about it. We expected it under perpetual to be 210. It was 200. We lost the 10. Going across, beginning plus purchases is goods available. Goods available is also this plus this, right? And that's true. 100 and 700 is 800. 300 and 500 is 800. And you can go through this. This is 1,000. This is 1,000. This is 650. This is 650. This is 860. This is 860. Right? So that's how we make the calculations. These two should equal these two. And to calculate shrinkage, it's the difference between what we expect under our accounting records and what actually exists. Now occasionally a store will come up and they'll have reverse shrinkage, and we'll say this is just ridiculous because our customers wouldn't be putting merchandise in our store. We could see them taking out merchandise, but where is this merchandise coming from? And when this happens, we usually say, well, you have an accounting system problem. Someone's not scanning when they should be, or someone's scanning too many items, or they're scanning improperly in some way. And so we have an adjustment. We wouldn't call it really shrinkage. We would just say accounting system errors of some kind. So we're really not really sure if this is theft or if it's accounting system errors. A lot of times you'll go in and you'll look and see if it's coming from particular stores. Or maybe it's when particular employees are working, because a lot of theft occurs from the employees. Again, the description of it is down here in the bottom if you need to recall the relationships. It's two algebraic equations, and in this case we have a third one, which is ending inventory and inventory counted. This is inventory from our accounting records, inventory from the actual count. So we have a third algebraic equation for this problem. We can work through this one. Gives us another equation. Again, we have beginning inventory plus purchases as goods available. And this is this number, right? So this plus this should equal this. Then this plus this should also equal this. But the third equation, which is in here, is revenue minus cost of goods sold is gross profit, right? So you're working through this and you have three equations again to work off of. The familiar goods available number, which comes from the two equations we've covered quite a bit, and they're just adding this last equation, which is sales revenue minus cost of goods sold to get at gross profit. So you go through and you work with the numbers that you know, and these numbers you know, you put that in, and then you can get that number. And if you have this number and you have this number, you can get this number. And I guess the important thing for us to recognize when we work through this problem, that goods available and goods sold, two different numbers, right? Cost of goods available means that it was available for sale and they could have sold it during this time period. Cost of goods sold is what the cost is of the actual merchandise that was sold. So we could work through this, and I'll let you work through it. I believe you can do that and come up with the numbers. This is under the perpetual system, recording journal entries for net sales with credit sales and sales discount, because we have cost of goods sold recorded with sales, so we're going to assume this is a perpetual system, and they just want us to do the journal entries. So first one, you're selling goods, and under perpetual you also have to record the cost of goods sold entry. So this is fairly straightforward, and if they put terms in here, you should know that this is an account receivable. And because it's a sale, it would not be an account payable, it would be an account receivable because we're going to receive the cash later. Perpetual, you're going to record both of those. So these two journal entries relate back to this one item up here, the first January 6th transaction. The second January 6th transaction you'll see here, it's very similar, only the amounts have changed. Now, on the 14th, you're going to collect the cash. When you collect the cash, again, the account receivable which you originally established here, and this is collecting from Wizard, which is up here, was for $100. You take it off. You record the cash, which is going to be 2% less because they paid within the discount period. It says 2% within 10 days. The 14th is definitely within 10 days. 10 days would be 6 plus 10 or 16. We are on the 14th. We're going to give them the discount. This is recorded in our contra account, our sales discount contra account. It is as a contra, it would be the opposite of revenue, which is a credit. It would be a debit. It would be sales discount debit to for the 2%, and the cash is not going to be 100% of $100. It's going to be the 98% of 100. On February 2nd, this is beyond the discount period. I said before 6 plus 10, they also have 210 net 30 for this one. 10 days after the 6th is the 16th. It should have been paid on February 16th. They did not pay on February 16th. They waited on January 16th, pardon me. They waited and they paid it on February 2nd. So they are very late. They are almost 2 weeks late in paying, and not quite 2 weeks, but close, and they're not near the discount period. So a reasonable company would not give them any discount, in which case they have to pay the $80, which we originally recorded in accounts receivable. On the 28th, we are going to sell goods again, and these goods again are sold and they have costs associated with them. We're going to assume this is in the perpetual system, so on the 28th you're going to have two journal entries. The first journal entry record the sales revenue, and the second to record cost of goods sold. So expensing of asset, recording revenue. This one we're going to fill in missing dollar amounts. And this is knowing how the flow or how a multi-step income statement should work. And you also have to know in this that net sales is the difference between revenue and sales returns and allowances. That this is contra accounts, therefore they are subtracted, the balances are the opposite balances. You also have to know that gross profit is the difference between net sales and cost of goods sold. So more algebra for you algebra fans out there, and you subtract the numbers to get the numbers that you need to have to fill in the values. I think that your Connect exercises will be very similar to these exercises.